Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, this is Alex. Welcome back to Safe Simple Sound. Today we're diving headfirst into the exciting world of technology and investing. Our discussion is fueled by an article titled Technology in Investing: How Digital Tools Are Transforming the Investment Landscape on safesimplesound.com website. It really highlights how drastically the investing world has changed, putting powerful tools right at our fingertips, tools that used to be exclusive to Wall Street pros. This resonates deeply with our belief here at Safe Simple Sound in seizing financial control and understanding financial choices. We want to equip you with the knowledge to make the most of these advancements. Two key takeaways jumped out at me. First, the sheer accessibility of investing now, thanks to mobile apps and robo-advisors. Second, the importance of balancing these powerful digital tools with sound investment principles. We'll be exploring that balance throughout this episode. So, here's our roadmap for today. We'll start with mobile trading and robo-advisors, exploring scenarios like the impulsive trader, where we'll see how easy access can sometimes lead to hasty decisions, and robo versus human, helping you decide which advising approach best suits your needs. This ties directly into creating a financial safety net, making sure you have the right support system in place. Next, we'll tackle data analytics and investment research tools. We'll examine scenarios like information overload, discussing how to navigate the deluge of data, and screening for success, sharing tips on using these tools effectively. We'll be emphasizing understanding financial choices here, making sure you're using data wisely. Then, we'll move on to the fascinating world of AI, machine learning, and NLP in investing. We'll explore scenarios like the algorithmic edge, considering the potential of AI in investing, and sentiment analysis and market trends, looking at how to interpret market sentiment. Finally, and crucially, we'll discuss cybersecurity and digital safety for investors. We'll cover scenarios like the phishing attack and data privacy concerns, because protecting your investments is paramount. This aligns perfectly with our principle of SAFE, ensuring your financial journey is secure. Get ready for an insightful and practical discussion on how to harness the power of technology to build a lasting legacy of financial well-being. Let's dive in. In previous episodes, we have been talking about the bigger picture of choosing between robo-advisors and human advisors, which brought up some interesting points about control and convenience. This leads us perfectly into our first scenario, which focuses on the potential downsides of having too much control and convenience at your fingertips. We're calling this one the impulsive trader. Imagine a young professional, let's call them Taylor, no relation to you, Taylor, who's just discovered the exciting world of mobile trading apps. They're hooked by the real-time data, the instant gratification of executing trades with a single tap, and the allure of quick profits. Unfortunately, they get caught up in the thrill of it all and start trading frequently, chasing short-term gains. As you might guess, market volatility hits, and Taylor ends up losing money. They're initially focused on these short-term wins, but eventually realize the importance of a long-term strategy. This, unfortunately, is a common story. Sam, what are your thoughts on this kind of scenario?
It's incredibly common, Alex, and highlighted in the article we referenced earlier. Mobile trading apps, while democratizing access to markets, can create a gamified experience. The constant notifications, the flashing charts, the easy execution, it can trigger dopamine releases, much like gambling. This encourages impulsive behavior, pushing users to trade more often than they should. It's the classic case of mistaking activity for productivity.
That makes so much sense. It's like when I get a notification from a shopping app about a flash sale. I suddenly feel this urge to buy something, even if I don't need it. I can see how that same impulse could lead to bad trading decisions. So, how can you avoid falling into that trap?
That's a great analogy, Taylor. That flash sale feeling is exactly what we're talking about. And that leads us right into one of our initial questions. How can mobile trading apps encourage impulsive behavior? We've touched on the gamification aspect, but what else contributes to this?
The ease of access is a huge factor. With a few taps, you can buy or sell stocks. There's no friction, no time to reflect. This can be especially dangerous for those prone to emotional decision-making. The article also mentions the potential for overtrading, which often goes hand in hand with impulsivity.
This reminds me of what we discussed about robo-advisors earlier. They offer automated rebalancing and generally discourage frequent trading, right? So in a way, they're kind of the opposite of this impulsive trading scenario.
Exactly, Taylor. Robo-advisors are designed with a long-term perspective in mind, often using algorithms to manage risk and maintain a balanced portfolio. They take the emotion and the impulse out of trading. But for those who choose to self-manage, how can we avoid those emotional trading decisions on mobile platforms? Which was our second question.
Several strategies can help. First, create a trading plan with clear entry and exit rules. This pre-commitment can prevent impulsive reactions to market swings. Second, limit the use of real-time data and notifications. The constant stream of information can fuel anxiety and lead to emotional trades.
So if I understand correctly, Sam, the key is to create a buffer between the stimulus, the market fluctuation or news, and your response, the trade. Is that right?
Precisely. Another useful strategy is to use a separate platform for research and analysis, away from the trading app. This creates a psychological distance that can help you think more rationally.
Those are all really helpful tips. Creating a trading plan feels especially important, almost like setting a budget for your investments.
So, Taylor, we just talked about the pitfalls of impulsive trading, especially with the ease of access provided by mobile apps. It highlighted the importance of having a long-term strategy. But developing that strategy can be tricky, and many people seek professional guidance. That brings us to another crucial decision facing investors today: choosing between a robo-advisor and a human financial advisor. This scenario focuses on a couple nearing retirement, trying to navigate this very dilemma. They have a complex financial situation and value personalized advice. So, Sam, when does a robo-advisor make sense, and when is a human advisor preferable?
Robo-advisors are great for those starting out or for people who prefer a hands-off approach. As our reference article mentioned, they excel at creating diversified portfolios using ETFs based on your risk tolerance, automatically rebalancing, and even doing things like tax loss harvesting. It's professional-grade portfolio management at a lower cost than traditional advisors. However, for complex situations like estate planning, tax optimization strategies beyond basic harvesting, or navigating significant life events like selling a business, a human advisor can bring invaluable expertise and personalized guidance.
So, if I understand correctly, robo-advisors are like a solid foundation, good for the basics, but human advisors are needed for the more intricate details? Like if this couple nearing retirement has significant assets from a family business or complex inheritance issues, a robo-advisor might not be enough.
Exactly. Think of it like building a house. A robo-advisor can lay the foundation and frame the structure, a diversified portfolio. But a human advisor can customize the house based on your specific blueprint, your individual financial goals and complexities. They can help with things like specialized tax strategies a robo-advisor might not be equipped for.
That's a great analogy, Sam. Now, Taylor, our second question for this segment was about combining the benefits of both. What are your thoughts?
This reminds me of what we discussed earlier about mobile trading apps. Powerful tools, but needing mindful use. Maybe you could use a robo-advisor for the core of your portfolio, the basic investments, and then consult a human advisor periodically for bigger decisions, like planning for large expenses or estate planning.
That's a very practical approach, Taylor. A hybrid model is becoming increasingly popular. You leverage the cost-effectiveness and automation of a robo-advisor for day-to-day portfolio management, and then tap into the expertise of a human advisor for more complex needs or significant financial decisions. For example, a robo-advisor can maintain your asset allocation, but a human advisor can provide advice on how a major life change, like an inheritance or a job loss, should impact your overall financial plan.
So we've covered quite a bit. Robo-advisors are ideal for simplicity and cost-effectiveness, handling the core aspects of portfolio management. Human advisors shine in complex situations, offering personalized strategies for specific circumstances, and a hybrid approach can combine the strengths of both. A key takeaway is that technology shouldn't replace sound financial principles. It's a tool to help you achieve your goals, not dictate them. Our call to action for this segment is this: carefully assess your financial needs and comfort level before choosing an advisor. Do your research on different robo-advisors and human advisors to find the best fit for your situation. So, Taylor, we just talked about finding the right advisor, whether it's a robo-advisor or a human. But even with the best advisor, you might still feel overwhelmed by the sheer amount of information out there. That's what we're diving into now: information overload. Imagine you've got access to every market data platform, every research tool. It's a double-edged sword, right? You have the potential to be super informed, but you also risk getting lost in the data jungle. This scenario is all about that feeling of analysis paralysis when faced with too much information.
Absolutely. I've felt that even just browsing basic financial news websites. There's so much coming at you: charts, graphs, expert opinions, social media buzz. It's easy to get sucked in and lose sight of what you're actually trying to achieve.
Exactly. So let's start with a key question. How can investors effectively filter and prioritize market data? Sam, what are your thoughts on this?
It's crucial to have a predefined investment strategy. That strategy dictates the type of data you need. For example, a value investor focuses on fundamental data like price-to-earnings ratios, while a growth investor might prioritize revenue growth and market share projections. Knowing your strategy provides the filter for relevant information.
So if I understand correctly, before even looking at any data, I need to know what I'm looking for. This reminds me of what we discussed about setting financial goals. Like, if my goal is long-term retirement savings, I shouldn't be swayed by short-term market fluctuations, right?
Spot on, Taylor. That long-term vision informs your strategy and therefore your data needs. It's about aligning your data intake with your investment objectives. Sam, what are some practical tips for implementing this filtering process?
Start by identifying key metrics relevant to your strategy. Create a watch list of companies or sectors you're interested in. Then set up alerts for those specific metrics. Many platforms allow you to customize these alerts. This helps you stay informed without getting bombarded with irrelevant noise.
That's excellent advice. Now, moving to our second question, what are the dangers of relying solely on technical analysis without considering fundamental factors?
Well, I've heard that technical analysis is all about chart patterns and historical price movements. But doesn't that ignore the actual health and potential of the underlying company?
Precisely. Technical analysis can be a valuable tool, but it's only part of the picture. Think of it like navigating with only a map and no compass. You know the roads, but not necessarily where you're going. Fundamentals like company earnings, management quality, and industry trends provide the why behind price movements. Relying solely on technicals risks reacting to short-term noise and missing the bigger picture.
Great analogy, Sam. For example, a company's stock price might be dipping due to a temporary market downturn, but its underlying fundamentals remain strong. A technical trader might see that dip and sell, while a fundamental investor might see a buying opportunity.
So it's important to have a holistic view, combining both technical and fundamental analysis.
Exactly. It's like having both a map and a compass. Technicals show you the short-term terrain, while fundamentals guide you towards your long-term destination.
So to recap, we've talked about the importance of filtering information based on your investment strategy and the dangers of relying solely on technical analysis. Remember, don't let information overload paralyze you. Develop a focused research process. Identify key metrics aligned with your investment strategy and use both technical and fundamental analysis to inform your decisions. Now, let's flip the script and talk about how we can actually harness the power of data through screening tools. In our scenario, Screening for Success, we'll explore how an investor can effectively use these tools to pinpoint potential investment opportunities based on their specific criteria. Imagine you're looking for a needle in a haystack. That's often what finding the right investment feels like. Screening tools are like having a powerful magnet that helps you pull those needles out. Sam, as our resident expert, can you give us a breakdown of what investment screening tools are and how they work?
Sure, Alex. Screening tools are essentially filters for the investment universe. You input your desired criteria, things like market capitalization, price to earnings ratio, dividend yield, sector, and so on, and the tool generates a list of companies that match. It's like setting up advanced search filters on an online shopping site, but for stocks.
So if I'm looking for, say, small cap value stocks with a high dividend yield, I can use a screener to find those specifically.
Precisely. It saves you the time and effort of manually combing through thousands of companies.
That brings us to our first key question. What are the best practices for using these powerful tools? Sam?
Start by clearly defining your investment strategy. What are your goals? What's your risk tolerance? The answers will inform your screening criteria. For example, if you're a long-term value-oriented investor, you might screen for companies with low price-to-book ratios and strong cash flow. Then, start with a broader set of criteria and progressively narrow it down as you refine your search. Don't try to screen for everything at once.
That makes sense. This reminds me of what we discussed about information overload. Too many filters could lead to missing some potentially good investments, right?
Exactly, Taylor. And that ties into our second question. How can investors avoid confirmation bias when using these tools?
Confirmation bias is the tendency to favor information that confirms your existing beliefs. With screening tools, this might mean setting criteria that simply validate your preconceived notions about a particular company or sector. A classic example is someone who's convinced a certain industry is booming and sets their screener to only show positive metrics for that industry, ignoring any red flags.
So if I understand correctly, even with these objective-seeming tools, our own biases can creep in. How do we counteract that, Sam?
Diversify your information sources. Don't just rely on the data presented by the screening tool. Read analyst reports, check independent financial news, and consider different perspectives. Also, backtest your screening criteria. See how they would have performed historically. This can help you identify any blind spots or weaknesses in your approach.
Great point, Sam. And remember, everyone, like Sam just mentioned, backtesting is key. Past performance isn't a guarantee of future success, but it can reveal a lot about the effectiveness of your screening strategy. So let's recap. Screening tools can be incredibly valuable for identifying potential investment opportunities, but they need to be used strategically. Define your investment goals, start broad, and then refine your criteria. And most importantly, be aware of your own biases. Diversify your research and backtest your criteria to ensure you're not just seeing what you want to see. Our call to action today: backtest your screening criteria and refine them over time. Remember that screening is just the first step in the research process. You still need to do your due diligence on the companies that make it through your filter. Speaking of powerful tools, the world of investing is increasingly being shaped by artificial intelligence and machine learning. In our next segment, The Algorithmic Edge, we'll delve into how hedge fund managers are using these technologies to try and gain an advantage in the markets. Stay tuned. So, Sam, this scenario we're calling the algorithmic edge. It gets to the heart of how advanced technology is changing the investment game. Our listeners, like Taylor, are eager to understand how these tools are being used responsibly and ethically. Taylor, what comes to mind when you think about AI in investing?
It's a bit of a black box to me, Alex. I mean, I get the basic concept of algorithms finding patterns, but how can we be sure these aren't just identifying random noise and creating false confidence? And isn't there a risk of these systems becoming so complex that no one truly understands how they're making decisions?
Great questions, Taylor. Sam, could you shed some light on how AI and machine learning can be used responsibly in investment management? This is our first key question for this segment.
Absolutely. Responsibility with AI starts with acknowledging its limitations. It's not a crystal ball. We use machine learning primarily to identify potential inefficiencies in the market, small discrepancies that might be missed by traditional analysis. Think of it like having an army of research assistants combing through mountains of data, looking for subtle signals. We still have human analysts verifying those signals and making the final investment decisions. The AI is a tool, not the decision maker.
That's a crucial point, Sam. It brings us to our second key question, the ethical considerations.
Right. A big ethical concern is bias. If the data you train your AI on is biased, the AI will perpetuate and amplify those biases. For example, if historical data reflects gender bias in CEO performance, the AI might unfairly penalize female-led companies. We constantly scrutinize our data and algorithms for such biases. Transparency is also vital. While we can't reveal our proprietary algorithms, we're transparent with our investors about how we use AI and what role it plays in our investment process.
So if I understand correctly, Sam, you're using AI to augment your analyst's abilities, not replace them. It's like giving them a superpowered magnifying glass to see market details they might otherwise miss.
Exactly. The reference article mentioned AI being used for analyzing company financials, processing news sentiment, predicting market movements, and portfolio optimization. We use it similarly. We might, for example, train an algorithm to identify companies with unusually high inventory growth relative to sales, a potential red flag that warrants further investigation.
That's a very concrete example, Sam. It clarifies how AI can be used in a practical way. Taylor, any other questions that this brings up for you?
This reminds me of what we discussed about information overload. If AI is processing so much data, how do you avoid getting overwhelmed by the outputs? It seems like it could create a different kind of information overload.
That's a valid point. We address it by focusing on specific, well-defined investment strategies. We don't try to use AI for everything. We choose specific areas where we believe it can offer an advantage. And crucially, we prioritize quality data over quantity.
So let's recap. We've talked about using AI responsibly by acknowledging its limitations, focusing on specific strategies, and verifying AI-generated signals with human analysis. Ethically, we discussed mitigating bias in data and algorithms and maintaining transparency with investors. Before we move on, remember, listeners, understand the limitations of AI and avoid over-reliance on algorithmic predictions. Continuously monitor and evaluate any AI-driven strategies you might be using. Don't let the allure of algorithmic magic blind you to the fundamentals of sound investing. For our next scenario, imagine you're a retail investor researching a particular stock. You come across tools that analyze social media sentiment and news articles to gauge the overall market feeling towards that stock. How reliable is this information, and what are the potential pitfalls? Taylor, what are your initial thoughts on using something like this?
It sounds almost too good to be true, Alex. Like I could just check Twitter and see if people are feeling bullish or bearish on a stock and base my decisions on that. This reminds me of what we discussed about information overload earlier. Wouldn't all that noise be distracting?
Exactly. That's one of the key questions. Sam, how reliable is sentiment analysis as an investment indicator?
Sentiment analysis can provide a snapshot of current market sentiment, which can be a useful data point. NLP, or natural language processing, algorithms can sift through vast amounts of text data, news articles, social media posts, blog comments, and categorize them as positive, negative, or neutral. A simple example is analyzing tweets about a company's new product launch. A predominantly positive sentiment might suggest increased investor confidence.
Okay, but might is the key word there, right? People can be sarcastic online or deliberately spread misinformation. What are the risks of relying solely on social media sentiment?
You're absolutely right, Taylor. There are significant risks. First, social media is prone to manipulation. Pump and dump schemes, coordinated buying and selling designed to artificially inflate prices before crashing, often rely on manufactured hype on social media. Another risk is mistaking noise for signal. A sudden surge in positive mentions might not reflect genuine investor interest, but rather a viral marketing campaign.
So it's like trying to hear a single conversation in a crowded room. There's a lot of background noise that can distort the message. Sam, the reference article mentioned NLP's use in analyzing earnings call transcripts. Is that a more reliable application?
Potentially, yes. Earnings calls are more formal and structured than social media, offering a clearer view of a company's performance and outlook from its management. NLP can analyze the language used, the tone, the specific words chosen, to detect subtle cues that might not be apparent through just reading the transcript.
So if I understand correctly, sentiment analysis can be a useful tool, but it's essential to consider the source of the data. Earnings calls are likely more reliable than tweets, and we shouldn't rely on any single source.
Precisely. It's about integrating sentiment analysis into a broader research process, not relying on it solely. To wrap up, sentiment analysis offers interesting insights into market trends, but it's crucial to be aware of its limitations. Social media sentiment is particularly susceptible to manipulation and should be interpreted cautiously. Remember, use sentiment analysis as one factor among many in your research process. Be wary of manipulated sentiment and misinformation. So, Taylor, we've just been talking about using NLP to gauge market sentiment. That's a powerful tool, but it also highlights how much we rely on digital platforms for investing these days. This reliance makes cybersecurity absolutely vital, and that leads us to our next scenario, the phishing attack. Imagine this. You're checking your investment portfolio online, and an email appears to be from your brokerage firm. It says there's been unusual activity on your account and asks you to verify your login details by clicking a link. You click, enter your information, and suddenly you've lost control of your account. This, unfortunately, is a classic phishing scam. Sam, can you tell us what are the most common cybersecurity threats facing investors today beyond phishing?
Absolutely, Alex. Phishing is certainly a major one, but it's part of a wider category called social engineering, tricks to manipulate people into giving up sensitive information. Besides that, we have malware, malicious software designed to steal data or disrupt systems. This can be anything from viruses and spyware to ransomware, which locks your computer and demands payment to unlock it. Then there's data breaches, where hackers directly target financial institutions or investment platforms. Finally, weak or reused passwords continue to be a significant vulnerability.
So if I understand correctly, it's not just about external threats like hackers. It's also about our own actions, like using weak passwords that can make us vulnerable.
Precisely. A strong, unique password for each of your financial accounts is fundamental.
Taylor's point is a good one. It's like locking your front door, a simple action but crucial for security. Okay, Sam, let's delve into phishing a little more since it's so common. How can investors protect themselves from these kinds of scams, and what should they do if they think they've fallen victim?
Vigilance is key. Look closely at the sender's email address. Are there any misspellings or unusual characters? Hover over links before clicking to see the actual URL. Does it match the supposed source? Be wary of emails urging immediate action or containing alarming language. And most importantly, if something feels off, contact your financial institution directly. Don't click any links in the suspicious email.
This reminds me of what we discussed about confirmation bias, how we tend to believe information that confirms our existing beliefs. We might be so eager to believe a positive message about our investments that we overlook red flags.
Excellent connection, Taylor. Now let's say someone has already fallen victim. What are the immediate steps they should take, Sam?
First, change your passwords for all affected accounts immediately. Then, report the incident to your financial institution and the relevant authorities. Monitor your accounts closely for any unauthorized transactions and consider placing a fraud alert on your credit report.
So to recap, strong, unique passwords are a must, two-factor authentication adds another layer of security, and skepticism is your best friend. Never click links in suspicious emails and always double-check everything.
So if I get an email about unusual activity, the best thing to do is to call my broker directly using the number on their official website or my statement, right? Not the number in the email.
Exactly. That's the safest approach.
Great questions, Taylor. And that brings us to another important aspect of online security, data privacy. How much information are these platforms collecting about us, and how are they using it? We'll explore that in our next scenario. So in this scenario, we've learned about the importance of cybersecurity for investors. Remember, your digital security is just as important as the physical security of your assets. Our call to action today: enable two-factor authentication on all your investment accounts and be vigilant about suspicious emails and websites. Stay safe out there. So, we just heard a cautionary tale about the very real dangers of phishing scams. It's a sobering reminder of how crucial online security is, especially when dealing with our hard-earned investments. But the security conversation doesn't end with just passwords and two-factor authentication. It extends to something equally important, and that's the privacy of our financial data. This brings us to another key concern: the data privacy practices of the very platforms we use to manage our investments. In this scenario, we're imagining a group of investors like ourselves discussing their worries about how much personal financial information they're sharing and what these platforms are doing with it. Taylor, as our resident inquisitive learner, I'm curious, what comes to mind when you think about your data privacy rights as an investor?
Well, Alex, after that last story about phishing, I'm definitely on high alert. It makes me wonder, what rights do I have when it comes to my financial data on these platforms? Do I even have any control over how it's used? I mean, I know there are privacy policies, but who actually reads those things cover to cover? They're so long and complicated.
You're absolutely right, Taylor. Those policies can be dense. Sam, can you shed some light on the data privacy rights investors should be aware of?
Sure, investors generally have the right to know what data is being collected, how it's being used, and who it's being shared with. This is often outlined in the privacy policy, as Taylor mentioned. You also have the right to access, correct, and sometimes even delete your data. Depending on your jurisdiction, you might have additional rights regarding data portability and restricting the use of your data for certain purposes like targeted advertising.
So it's not a completely hands-off situation. We do have some agency here.
Okay, that's good to know. But even if I understand my rights, how can I actually ensure these platforms are handling my data responsibly? It feels like once it's out there, it's out there.
That's a valid concern, Taylor. It's kind of like entrusting a friend with a valuable item. You want to be sure they'll treat it with care. Sam, what practical steps can investors take to verify a platform's data practices?
Start with researching the platform. Look beyond the marketing materials and delve into their privacy policy. Pay attention to details like data encryption methods, their data retention policies, and whether they sell data to third parties. Independent security audits and certifications can also be a good indicator of their commitment to data security.
It seems like due diligence is key here. So if I understand correctly, I should be looking for things like encryption, responsible data sharing practices, and independent audits.
Precisely. And don't hesitate to contact the platform directly with any questions about their data practices. A reputable company will be transparent and willing to address your concerns.
That's a really important point, Sam. Transparency is key. If a company is being vague or evasive about their data practices, that could be a red flag. Let's recap the key takeaways from this section. First, understand your data privacy rights. Second, actively research the platforms you use, paying close attention to their privacy policies and security measures. Don't be afraid to ask questions. And that wraps up our deep dive into the evolving world of technology and investing here on Safe, Simple Sound. We explored how digital tools, from mobile apps to AI, are transforming the investment landscape, just as discussed in that insightful article, Technology and Investing. We touched on crucial points like the democratization of investing through technology, the power of data analytics, and, critically, the absolute necessity of cybersecurity. I think our discussions about the impulsive trader and information overload were particularly impactful, highlighting the importance of balance and thoughtful decision-making, even with all these amazing tools at our disposal. Remember, technology should empower your investment journey, not dictate it. Thank you all so much for joining me today. Your time and attention are truly appreciated. Don't forget to check out the show notes for links to the article and other resources. Leave us a review. We love hearing your thoughts. And please subscribe to Safe Simple Sound so you don't miss our next episode, where we'll be discussing tax-efficient investing. Until then, remember the core principles of Safe Simple Sound. Seize financial control, understand financial choices, create a financial safety net, and build a lasting legacy. This is Alex, wishing you a safe, simple, and sound financial journey. See you next time.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.